Hi, everybody, and welcome to the newest episode of the HubSpot Agency Expert Webinar Series. I'm absolutely delighted to be joined on the line today by Blair Enns. Blair is on a mission to change the way creative services are bought and sold the world over. He is the founder and CEO of Win Without Pitching, the sales training and coaching organization for creative professionals, and is the author of 2 books on selling and pricing for creative professionals. He's also the co-host, along with David C. Baker, of Two Bobs, the podcast for creative entrepreneurship. And he lives in Caslow, British Columbia, Canada, and lectures throughout the world. He's spoken to dozens of conferences and organizations on 5 continents. If at any stage you'd like to join the conversation or ask us anything, please do tweet us at #AgencyExpertSeries. We'd really love for you to get involved, and we'll be doing a short Q&A towards the end. So Blair, without further ado, I'm going to hand over to you.
Thank you very much, David. I'm so happy to be here. I hope everybody can hear me. I wanted to be on camera as well, but it's not showing. So just bear with me, everybody. I'm going to see if I can fix that on my end, or maybe you can fix that on your end, David. Maybe you can't.
Say that again, Blair.
Just wondering. I wanted to be on camera as well, but it's because I spent so much time doing my hair. Forget about it. You've got the slides. You'll hear my voice. Let's do this thing. Okay, everybody. Thanks for the nice introduction, David. It's really my honor to be here. I've had the pleasure of doing a bunch of talks and webcasts like this and live in person at various events for HubSpot over the years. So it's really my pleasure to do this. I think the name of my talk was originally introduced as the fundamentals of pricing. I don't want to talk about the fundamentals of pricing. I want to go beyond the fundamentals of pricing. I want to talk about what I would consider to be the next 2 levels of pricing success. So the talk is largely framed by my brand new book called Pricing Creativity, A Guide to Profit Beyond the Billable Hour. I'm going to walk you through some of the principles and rules in this book, and I'll describe what I mean by that, because the book is really broken up into these 4 different sections of principles, rules, tips, and tools. I'm just going to wait here. I've got a little bit of a lag I'm seeing on my monitor here. Okay, great. So that's how the book's broken down into these 4 different areas: principles, rules, tips, and tools. And I'm not going to talk about all of that today. My goal is to give you as much information as I can in 45 minutes or so, and that'll leave about 15 minutes for Q&A, that you can take away and use to immediately start making more money. Now, I believe that if you apply just some of these principles and rules that I'm going to talk about today, the average creative or marketing firm should be able to increase their profit by 50% or greater. And those numbers might sound a little bit outrageous to you, but when you do the math, I'm not going to do them here. I do them in the book. When you do the math, it's actually pretty straightforward, pretty easy. But if you, for the typical creative firm, if you want to increase your profit by 50%, you really only need to raise your prices by about 10%, and that assumes a 20% profit margin. So 10% isn't so bad. You could probably try to institute a 10% price increase across the board to all of your clients today, and you would find that some of them would accept it and some of them wouldn't accept it, and they would go hire somebody else. So on average, who knows where you would net out? But if you simply change the way you price, or if you change the way you price in addition to raising your prices, then it becomes far easier to be able to charge more and thereby increasing your profit dramatically disproportionate to the percentage rise in price. Okay, so when I talk about the way the book is broken down, principles are things that I really want you to understand. Rules are the things, and there are six rules of pricing creativity in the book. I'm not going to talk about all of them. Let me back up to principles for a minute. So when I went down the pricing rabbit hole, when I had the awakening and I realized that I knew very little about pricing or about value and decided to do some research, I thought, well, I'll just read a few books and then I'll be able to check that box that I understand pricing and I understand value. Well, a few books turned into dozens of books on pricing theory, which is a massive field. And also many, many books on behavioral economics and then related fields, even some macroeconomic stuff that I got a little distracted with. And so in the book and in my talk today, I want to, my goal was to take all of those principles and to distill them down into the fewest key principles that you really need to understand at the basic level, so that when you're applying the rules and the tips, and we'll talk about tips and tools in a minute, then you know why they're important. So I'm going to talk about 2 key underlying principles today. Then I'm going to talk about 3 or maybe 4 of the rules of pricing creativity, the easy ones that you can easily take away today and begin applying today, or the next time you are crafting and pricing a proposal. The tips section is really specific situation guidance. So in certain situations, if you're thinking about retainers, there's a chapter on retainers, there's a chapter on negotiating, et cetera, et cetera. And then the tools section, the book is available in 3 different formats, but it was really written as a manual. And so that's kind of the primary format. Is it shows up, you can buy the manual version, which has the added tools section. And that is the section at the back that you turn to and where you reference the checklists and templates the next time you are crafting and pricing a proposal. So again, today I'm going to talk about a couple of principles and 3 or 4 rules, depending on how much time we have. And you should be able to take these away and start making more money almost immediately. So I'll start with the first principle, or the first principle that I want to talk to you about here today. And that is this idea that value and fairness are subjective. Value and fairness are subjective. Now, it's largely understood today in the world of pricing and economics that all value is subjective. It's known as the subjective theory of value, and it's reigned since about 1905 or 1906. But it wasn't always the reigning theory of value. In fact, in 1776, Adam Smith, who is known as the father of economics, he founded the field of economics when he published his book, Wealth of Nations. It's got a longer title than that. It's actually 5, I think it's 5 tomes that it's truncated down to this title called The Wealth of Nations. That's Adam Smith on the left. And in The Wealth of Nations, Adam Smith put forward the labor theory of value, which reigned from about 1776 till about 1905. And the labor theory of value said that you can measure the value of something based on the amount of time and materials or effort that it took, that went into producing it. Now, Smith's theory kind of held tenuously over that period of 130 years or so. And it was only tenuous because the father of economics could never explain what profits were in that model. Now, Karl Marx is the man on the right. He came along and he said, well, I'll tell you what profits are. Profits are excess value stolen from the worker. And so on Smith's labor theory of value, Karl Marx used that to build his kind of exploitation theory of capitalism, how capitalists were exploiting the workers. And it's interesting that today, even though in 1905, 1906, 3 different economists are credited with arriving at the subjective theory of value at roughly the same time. And the subjective theory of value says that value is like beauty. It is in the eye of the beholder. So we're all kind of, not all of us, I certainly wasn't until I read the history of it. But most of us understand this key principle, but I don't think we understand the purity of it. Because when I tell you all value is subjective, you probably think, well, yeah, that's mostly true. I can see how different people value different things differently even at different times. But imagine in a B2B sale, and this is the thought process that I went through when I was trying on the subjective theory of value, the idea that all value is subjective. I imagined a B2B sale where I'm selling to 3 different individuals on the client side of the table. And all 3 of those individuals are working from the same kind of corporate directive or mission or idea of the value that they're hoping to create. And it might be, we need a new website because sales have dropped 20% and we need to get sales back to where we were. And that might be the directive coming from the CEO or the CMO or somewhere in the C-suite. And I'm dealing with 3 people below that level. Now, so they're all focused on the same corporate need or mission or the value that they want to obtain. But we need to remember that we're not businesses or corporations selling to corporations. We are people selling to people. And we can imagine that each of those 3 decision makers on the client side of the table, each values different things. So the first client might be sitting there thinking, you know what, this isn't my priority. My focus is somewhere else. My bonus is tied to something else. So in that case, that person might value the agency that she feels would require the least amount of supervision, hand-holding, or oversight from her. Now, the second person might be sitting there thinking, I remember the last time I hired an agency, things went bad and I almost got fired. So his concern is, what he values most is the least risky option. And a least risky option might include somebody an agency that wants a lot of face-to-face time, a lot of interaction time, quite the opposite of what client number 1 wants. And client number 3 might be sitting there thinking, oh, you know, I really want to work with that all-star creative director at this other firm. That guy's famous. He's just won all these awards. And that's really important to me personally because I want to be seen as somebody who worked with this star. So you can see how even though the corporate objectives are all the same, the individual human beings are going to value things differently. And they're going to play different games to rationalize that value with themselves. They're going to use different math to decide how much of that excess value in the form of that they're willing to share with you in the form of compensation. So all value is indeed subjective. So the first principle that we're talking about here is that value and fairness are subjective. So value is subjective. Different people value different things at different times. Now, fairness, you can take, there's another equation for value or a model for looking at value that says there are 3 forms of there are 3 types of value you create for your clients, or you might create for your clients. And the first 2 are economic. They're revenue gains and cost reductions. You help prices, or you help revenue or profit go up, or you help them save costs. And the third area is what's known as emotional contributions to value. These are the highly personal. These are the feelings that people use. So you could argue that 2/3 of the value that you might create for the client are economic in the form of revenue gains or cost reductions. And that the feelings or what's important to the person individually, that represents a third category. And then there's some kind of, there's some sort of math or equation around, and I don't have it for you, but around how we use those feelings as multipliers of economic or detractors of economic value. Fairness, on the other hand, is just a feeling. So one of the rules that falls out of this principle, it's the first rule I'll talk about in a few minutes, is you price the client, not the job. If all value is indeed subjective, that means that different clients value different things differently. So if you're providing the same service to different clients, and even if your costs or inputs are the same, it's going to be worth different things to different people. So I want to play a little game with you here. You're seeing 2 logos on the screen. One is the Nike logo, one is the Pepsi logo, and the headline is, are these logo prices fair? Let's talk a little bit about fairness. We'll keep talking about the subject of value as well. In 1971, Phil Knight, the founder of Nike, paid design student Carolyn Davidson $35 to design the Nike swoosh. So that's about $200 in today's money. And so if you had the ability to answer my question here on this format, I would ask you, do you think that price was fair? Was it fair to the client? Was it fair to the designer? And I've asked this question many times in talks, and some people are adamant it wasn't fair to the designer. Well, I'm pretty pretty sure that at the time, Carolyn Davidson, who was a design student, was happy to get the $35 and the piece of work in her portfolio. And as time went by and Nike became more successful, the value of that piece in her portfolio increased. Now, there may be a line that was crossed after much time when all the risk had gone away, where Davidson thought, Nike's now this multi-billion-dollar corporation. I don't feel like I was fairly compensated. And that probably explains why many years later, Phil Knight gifted to Davidson a diamond ring in the shape of the Nike swoosh and an undisclosed amount of Nike stock, rumored to be in the millions of dollars. But at the time, it was a $200, in today's money, a $200 interaction. And I would suggest to you that both parties thought the interaction was fair. There was this double thank you moment where Davidson handed over the design and Phil Knight said thank you, and he meant it. And he handed over the check for $35, and Davidson said thank you, and she meant it. Now, in 2008, let's fast forward a little bit. Pepsi hired design firm Arnell to redesign the Pepsi logo, and they paid them $1 million. So the question I like to pose to the audience, especially an audience of graphic designers, if you're in the logo identity business, you go to a party and somebody asks you, what do you do? And you say, I'm a graphic designer. Oh, you design logos? Yeah, we do corporate identities, product identities, in addition to other design. Okay, what does a logo cost? What do you charge for a logo? Now, I could ask an audience of designers, what do you charge for a logo? And I'm often hear some numbers, 5,000, 10,000, 50,000. I more often hear a range, 20 to 30,000, whatever the range is. But usually I hear, well, that depends. Because the answer, we've already established just from these two examples that the answer to the question, what does a logo cost, is $200 on the low end and $1 million on the high end. Nike paid $200 for their logo. Pepsi paid $1 million for their logo. And I like to ask, do you think that price was fair? That Pepsi price was fair? Do you think it was fair to the client? And a lot of people say, no, that's $1 million is outrageous. And you know what they're doing when they say that, right? They're calculating based on the inputs of time and materials. They're practicing Marxists. They're saying, well, there's no way it took you that long. So what's the difference? So if logos cost between $200 and $1 million, so that's a multiple of 5,000. One logo is 5,000 times more expensive than the other. Is it because, yeah, sure, time has passed, but we're valuing it in today's dollars? Is one logo 5,000 times better than the other? Did it take 5,000 times more hours to design the logo? Of course, those are ridiculous. And when I ask, do you think the Pepsi price was fair? I'm pretty sure that when Arnell handed over the design, the CMO and the people at Pepsi said thank you and handed over a check for $1 million, and the design firm said thank you. It was another double thank you moment. I actually think that Arnell left a significant amount of money on the table. I think they could have charged a whole lot more for the Pepsi logo, because the value of the Pepsi logo at the time that it was redesigned, it was a multi-billion-dollar brand, whereas Nike was a startup, right? So what is the basis of the price difference? It's value, and value can be measured in a bunch of different ways, and one of the ways is risk. Risk is essentially an emotional contribution to value while it's still risk, before the scenario plays out. After it plays out, it becomes this very real economic thing of revenue gains or a revenue not gained, or cost reduced or cost not reduced. About the same time Pepsi was redesigning their Pepsi logo, they also hired a design firm. It was actually the same firm, Arnell, to redesign the Tropicana Pure orange juice packaging. And you can see the old packaging on the left. This is the old packaging, and the new packaging was on the right. The new packaging hit the stores, and in the first 2 months, sales plummeted by $37 million before the old packaging was quickly restored, and then the sales drop leveled off, and sales went back to where they were before. Now, if the Pepsi brand had experienced the same drop, the equivalent would have been north of 200 million in lost sales. $200 million in lost sales. So I ask you, was the price that Pepsi paid fair to both parties? And what was Pepsi buying? They weren't buying hours. They were buying risk mitigation. They were buying the potential for a significant increase in profit, and they were probably assuaging or mitigating the fear that any misstep could be catastrophic in financial terms. Okay, that's principle number one, is that value and fairness are both subjective. Like beauty, it's all in the eye of the beholder. The second principle that I want to talk to you about today is this idea that efficiencies come at a cost of extraordinary profits. And it's not just efficiencies, it's actually the pursuit of efficiencies. Just like I think it's in the Bible, it's not that money is the root of all evil. It is the pursuit of money that is the root of all evil. It's the pursuit of efficiencies that come at a cost of extraordinary profits. Actually, you give up more than just extraordinary profits. The reason you give up extraordinary profits when you pursue efficiencies, and we'll talk about what I mean by efficiencies, is that you give up the ability to innovate and create extraordinary value for the client. And the reason is, when we talk about efficiencies in a creative firm, we're talking about utilization rates or billable efficiencies. So we're talking about you capturing and billing as many of the available hours of all the people in your firm as possible. And there are ratios that many firms live and die by, and many consultants advise firms on, and I've seen those ratios have a fantastically positive effect on firms and increase their profitability. But your ability to go from a kind of a struggling or barely surviving firm to a profitable firm where you can relax and maybe your personal income is at a place where you're now comfortable, you can get there through efficiencies, but you cannot get much farther than that. In fact, by pursuing efficiencies, you give up the ability to go to earn extraordinary profits. Now you'll see, here comes the slide. You can see this graph, it's from the book. It's not quite as scientific as it looks. What I'm graphing is AGI per FTE. So adjusted gross income per full-time equivalent employee. Now, if I could only have one number about your firm to make a whole bunch of inferences and predictions about the success of your business, this is the number I would want. And I've asked hundreds of firms for this number that we work with in our training program, and previous to that, when I worked as a consultant. I would get them to do the calculation and basically take your adjusted gross income, let's just call it's your fees, less any cost of goods sold or flow through. So it's basically the fees that you bill. So take the fees that you billed in the last 12-month period for which you have, and divide that number by the number of full-time equivalent employees. So you might have 9 full-time employees and 2 half-time employees. That adds up to 10 full-time equivalent employees. So let's say that yours is a 10-person firm billing. I'm going to do this in US dollars. Yours is a 10-person firm billing $1.5 million. So your turnover and fees only is $1.5 million. Your AGI per FTE is $150,000. So that's $150,000 in fees per full-time equivalent person. Now, the scientific part here that some of it's valid, some of it's just representing what it is that I'm seeing in the market, and I'll talk about that in a minute. The scientific part, the valid data, comes from my colleague and podcast co-host David C. Baker from Recourses, who's collected these statistics this data from tens of thousands of firms. And what he says is the average AGI per FTE is somewhere south of $145,000. So I've just put the distribution at 150 on the main distribution curve here. And what David says is the threshold of respectability is about 160,000 per person. So I generally see this distribution that you see in the first, the largest curve, I generally see that across most of the firms I work with. I ask them for their AGI per FTE and they give me a number. And sometimes, I see a lot around the 120, up 150, 160, 170, 180. And then you see very few around 200, and there's kind of this gap between 200, 225, 230, et cetera. And then all of a sudden, bang, you start hearing numbers that are way out there, like 300, 350, 400, 450. You don't hear 450 very often, but I heard one not too long ago. So in your firm, if you've already calculated the math and you're doing, let's say it's 100,000 euros per FTE, just imagine doing 4 times that. You probably, a lot of you listening to this can't even imagine that. And you can't even imagine that because you're thinking in terms of efficiencies. You're thinking, well, we'd have to bill more hours, or we'd have to charge a whole lot more per hour. And there's no way the client would pay hundreds of euros per hour. And so the point here is, if you want to earn that kind of income in that 250, 300, 350, 400 plus per FTE, you have to let go of time. You have to let go of the pursuit of efficiencies, because I said the first thing that you give up is the ability to innovate. As you pursue efficiencies, as you become more efficient, this becomes harder to do. And what this is to innovate for the client and drive extraordinary value for the client, and then to capture extraordinary profit for yourself. And the reason, if you haven't figured it out already, is innovation is inherently wasteful. Innovation is messy and wasteful. It requires people to have time to put their feet up on the desk. It requires freedom to fail. Efficiency is the elimination of waste. So the harder you are driving to pursue the elimination of waste, the more you are driving out of your organization the ability to innovate, truly innovate for your clients, to create extraordinary value, and to generate extraordinary profits for yourself. So when I hear somebody saying, when somebody calculates their AGI per FTE for me, and I hear $310,000, I say, how do you price? And the answer is almost always, we value price. There are 3 things that you can sell in your firm. You can sell the inputs of time and materials. You can sell the outputs of deliverables, and that's usually at market price, in air quotes, market price. Or you can sell the outcomes. You can sell and price based on the value that you would create for the client. So these are the 2 principles, value, that I want to talk to today and build on. All value and the idea of fairness are entirely subjective. So they differ from individual to individual. And the pursuit of efficiencies comes at the cost of extraordinary profits, at the ability to innovate for your client, to create extraordinary value for your client, and to generate extraordinary profits for yourself. So now I want to touch on some of the rules of pricing creativity. And there's a little bit of a lag here. And the first rule, and we're going to go through this first one real quick because I've already covered most of it. The first rule is to price the client and not the job. So the rule, if an application of the rule would be, if somebody comes to you and says, what do you charge for X? You should not have an answer. You should not even have a range, because the answer is, well, it depends. And it does not depend on the market value of X, the outputs. It does not depend on the inputs that went into X, time and materials. It depends on the value of X to the client. Now, I should take a note here whenever I have a chance to address, I'll just throw this quote from Ron Baker up here. I've had the honor of sharing a stage with Ron last week, and he says the most common pricing mistake among professionals alongside underpricing is pricing the service or the job and not the customer. I should point out to HubSpot partners here that and I talk about this in the book, there's a trend among many HubSpot partners to follow the lead of HubSpot when it comes to pricing. Now, HubSpot, like most SaaS companies, they're fairly sophisticated pricers. So if you go to their pricing page, you see a bunch of the rules employed that I'm talking about and I'm going to talk about today. And those rules, the application of those rules are a little bit different for a marketing services firm, because HubSpot is a productized services firm. It's infinitely scalable. They can sell to as many people as possible. Their business is built around infinite scale. A customized services firm is not built around the idea of infinite scale. It's built around the idea that every client is a blank canvas, is a blank slate of possibilities. And every year, so you should have a small, finite number of clients. That number is somewhere between 10 and 15, 8 and 15, actually. Let's just take the number 10 because it's easy to work with. So you should have roughly 10 clients. Each of your clients should be, because they're all value things differently, right? So you should be in the sale. You should be intently focused on the value what that client values and the value that they want you to create for them. And you should be assembling a solution and a price that is specific to their situation. So because yours is or should be a customized services firm. And I talked about this at Inbound last year. I've talked about it to many HubSpot audiences. It's this mistake, which I'll name in a minute, is endemic within the HubSpot ecosystem. So you need to be careful. And the mistake is you're getting caught, not many of you are getting caught between this mushy middle of productized services company on one end that HubSpot is, and customized services company on the other end that you should be. And you're productizing you're packaging and productizing your services, and you're putting the prices for these packages on the website. That's a huge mistake. You should be putting together bundles and packages and different prices like HubSpot does. But your segmentation strategy is each client essentially represents a segment. When you get to hundreds of clients, that's when you have to start segmenting your products and putting these definite packages on your website. You as a marketing services firm should not be doing that. So I talk about that more in the book. And if you want more on it, you can, here on YouTube, you can look for the talk that I did at Inbound 2016. I think it's called Price the Client, Not the Job. So that's rule number one, price the client, not the job. And so if we're taking that to heart, we're not publishing prices on our website. We're not saying package A costs this much, package B costs this much, and package C costs this other price. You're doing that, but the packages and the prices are different from client to client. Okay. The second rule that I want to talk about today, second rule of pricing creativity, is to offer options. Now, a lot of you do this well already. You're already putting options forward to your client, and that's great. You just need to make sure you're obeying rule number one and you're pricing the client and not the service, right? Because if the service shouldn't cost X, the price of X depends on the value you would create for the client. So if you're not offering options, if you're just putting forward a standard proposal with one option and one proposal, you're essentially putting forward a take it or leave it proposal. And there's a bunch of reasons why this is a mistake, but the big one is if you put forward a proposal for $50,000, or maybe it's $10,000 a month, whatever it is, you're asking the client to answer a question their brain isn't wired to answer, which is this proposal worth $50,000 or $10,000 a month? They can only, they can't look at that and measure. They need context, just like you need context to tell me, to be able to answer the question I'm going to give you next. And I'll just wait for my slide to, just wait for the lag here. And my next question is, there's a stick on the screen. What do you suppose the length of that stick is? I don't mean the length of the stick on your screen or that you imagine it to be on my screen. I mean, in real life, what is the length of the stick? And some people take a guess at it. I heard somebody say 40 centimeters the other day, and I've heard 4 centimeters, and I've heard, multiple feet. So the answer is you don't know what the length of that stick is because there's no context. For you to have a sense of the length of the stick, I would need to place something next to it, like a ruler or a tennis shoe or Saturn, so that you can get a sense of the scale. And that's the same thing that's happening in your client's mind when you put forward a take it or leave it proposal. And you're basically saying these services are worth $50,000, and the client's going, is it really worth $50,000? Because to answer the question, is this worth $50,000? The client needs something against which to compare. So you're forcing the client to actually leave physically or mentally, so that they can make a comparison. And where do they go for comparisons? They go to your competitors. The validity of this idea that human beings can't subjectively perceive absolute value was driven home to me when I was reading William Poundstone's book called Priceless. And I was lying in bed reading this, and I saw this image in his book. It's from MIT cognitive scientist Edward Addison. And in the book, Poundstone says that lettered squares in this image, A and B, are the same color. But your brain doesn't see them that way because we're kind of wired to see contrasts. And I thought, well, wait a minute, these aren't the same color. These are very clearly different colors. And he said, no, they're not, Blair. Get up out of bed, get some pieces of paper and cover up the other squares. And you'll see when you cover up the last square, you'll hear this click in your brain. And you'll see that both of these squares are the same color. Now, I'll save you the trouble from doing that. And I'll just show this second image where we run a couple of lines through these squares. And you'll see that these are indeed the same color. And you can get a sense of the optical illusion that the shadow of the column is creating here. So you look at those and you realize those are the same color. And that's when the light really went on for me. If you control the comparisons, I can have you think that black is white, that white is black, that heavy is light, that wet is dry, that dark is light. All of these things, because all of these things are kind of relative states. They're not absolute states. They're relative values, not absolute values. So the value of your proposal is measured relatively, right? So when you put forward, so from this day forward, when you follow the rule, you'll put forward a proposal with options. Now, 3 options is the best. 3 is always better than 2 because there's a principle known as extremeness aversion, where people avoid the edges and they go towards the middle. So your expectation is people will choose the middle option. You can do 4 as well. Once you get 5, it gets complicated and messy. So I'll just talk from here on out, I'll just talk about using 3 options. So when you put forward a proposal with 3 options, you will see the shift in your client's decision-making as their brain goes to work answering the question it is indeed wired to answer, which is not it's not, are we going to work together? It's not, is this worth $50,000? And the question changes to, how will we work together? Which of these is the best value? That's the question the brain is wired to answer. You need to be enabling that question. And you'll see if you follow this second rule of offering options, and it's built on the first rule of price the client, not the job, and then you add in this third rule, now you are at a whole new level of pricing success. And the third rule is anchor high. And anchoring, also known as by its fuller title of anchoring and adjusting, anchoring is it's a Nobel Prize winning science that basically says the first piece of information we get on an area when we're trying to make a decision skews the ultimate decision that we make. And so when we are anchoring high, what that means is when you put forward your 3-option, 3-column proposal to the client, you lead with the highest price. You lead with the high anchor, because the job of the anchor price is not to sell the anchor option. The job of the anchor price is to make the other prices, the prices of the other options, look more affordable. Now, I did an interesting anchoring survey 4 or 5 years ago now. I was conducting a seminar in Atlanta, Georgia, with about 70 firms, principals of 70 firms, along with my colleague, David C. Baker. And I put forward a question to all the participants of the seminar a few days in advance. And the question was, thinking of the firms that will be in the room, and they didn't know who would be in the room, what is your estimate of the average blended hourly rate of those firms in the room? And the average answer that we got back was $171. So the average response was, I think they're the average firm in the room. I think the average of the blended billable hourly rates will be $171. But as you can see, that was the control group answer. So everybody got that question, but 50% of the audience got another question first. It was preceded by this anchor question. So the anchor question was, do you think the average blended hourly rate of the firms in the room will be greater or less than $500? And because I asked that question, the respondents immediately start to think of the more expensive, more sophisticated firms that they know, and their answer skews towards those types of firms. So the anchor group answer, once they were asked the question, what's your estimate of the average blended hourly rate of the firms in the room, it was 38% higher. This is really powerful science. Again, what happens is in Daniel Kahneman's book, Thinking Fast and Slow, he talks about this system one, these two systems of thinking. System one is this cognitively efficient system that kind of makes quick leaps, quick assessments, really quick judgments. And then sometimes, not always, we employ system two, usually on complex or expensive issues. We employ system two, which is the more cognitively expensive, kind of laborious, effortful, analytical thinking system. We employ system two to reason away from the initial assessment we made with system one. And what all the science shows is we kind of reason away from the conclusion that we effectively jumped to, and we get to kind of a range of what might be a reasonable response or decision, but we kind of stop at the near end of that range. And anchoring is so powerful that you don't even know, it's so powerful that it's hard to undo the effects, even when you know it's being done to you. So I used to say it's impossible to undo the effects, but as more time goes by and more studies are done on it, there are a few different ways where you can kind of prime yourself to defend against the anchoring effect. The good news is nobody knows what they are. I mean, I know what they are. I can tell you what some of them are. One of them is to shake your head no when the anchor price is being delivered to you. There are some other ones. I get somebody to throw out the anchor price, no, and come back with another lower price. So there are a few of them. Don't worry about it. The net effect is, even if a client knows what's going on, he cannot undo the effect. There's also no boomerang effect. So if here's a simple 3-column proposal where the cheapest price might be the client's budget. The anchor price is really expensive, and then the desired option is the middle. On average, most of your clients will choose the middle option. It really does depend on how you structure things. But I made the point, there's no boomerang effect. Your anchor price can be really high, and on average, they do this science with mock juries where the lawyers will ask for the plaintiffs lawyer will ask for a huge settlement, just way out of scope. Like, I burned myself on a hot cup of coffee. Your client owes me $1 billion, like a crazy amount of money. So there's no one-to-one correlation, but there are power curves on this. The net effect is that there's no such thing as an anchor that's too high. Now, a friend of mine proved this recently because he wrote an article about this. He had a client whose budget was $30,000. He led with an anchor option that was priced at $30 million. Yes, you heard me correct. 1,000 times the client's budget. The client didn't buy the anchor option. He said, indulge me. I've got this really big idea. It's way beyond the budget we're talking about. It's a $30 million. It's going to cost you $30 million to do this. But let's have this conversation because it's opened up the door to a different way to think about your challenge. The client bought the middle option, which was priced at $300,000. So they bought a solution that was 10 times their budget. The anchor price was 1,000 times their budget. There is no there is no boomerang effect to having an anchor price that's so high. So the anchor is not there to be bought. Its job is to make the other options seem more affordable. I want to get to your questions here. I have one last rule that I want to talk about. I'm going to go through this fairly quickly. The rule is to master the value conversation, because this is really, I said off the top, I don't want to talk about pricing fundamentals. I want to talk about the next two levels of pricing success. So the next level of success, if you just applied the last two rules that I shared with you, which is always offer options and begin with a high anchor, you should be able to make significantly more money. Now, if you layer in the first rule, if you begin with the first rule that you price the client, not the job, therefore every proposal is differently priced. You're thinking not about what it costs you. You're getting those standard prices off your websites, and you're thinking about the value that you deliver to your client. Then that takes you to the next level, the highest level. But to get to the pinnacle of that highest level, the level within the level, you need to master the value conversation. It's one of the rules. It's a chapter in the book, Master the Value Conversation. It's the chapter that I put the most effort into, because I realized that this is a subject of tacit knowledge. This is the value conversation. I'll describe it here. The value conversation is the conversation in which you endeavor to determine the value you might create for the client and the share that you might command while maintaining the practitioner position. Let's ignore that second part, because I want to go through this very, very quickly. What you're seeing from the diagram here is we at Win Without Pitching see the value conversation as the third sale in an arc of the third conversation in an arc of 4 conversations. So each conversation has a different objective. Each conversation has a different framework for navigating to that objective. So at any point in the sale, you simply ask yourself, what conversation is this? Number one. Number two, what is the objective of this conversation? And number three, what is the framework that I use to navigate to that objective? So the value conversation is the third one in this arc. When you complete the value conversation, you are 3/4 of the way through the sale. And I'm going to give you the framework. I'll come back to this slide. I'm going to give you the framework for navigating the value conversation. It's simple, but it's not easy. So sorry, we'll just skip over this slide and I'll come back to it, or I'll speak to it, and then we'll move on and take your questions. This is the framework you use to conduct the value conversation. It's 4 steps. It's, first of all, what is it that you want, Madam Client? So getting to the heart of what this person, what this individual values. You focus on what she wants. She'll talk about corporate needs, but you want to get what it is that she values as well. Number 2, what are the metrics of success? What are the things that we will measure to determine if you have achieved what it is that you want? The third step is determining the value of hitting these metrics. Okay, if we hit these metrics, what is this worth? And this is where you want to convert it or drive it all to economic value if possible. And if you determine in step 3 that if you help the client achieve what she wants and hit these metrics that you've agreed on, that are the metrics of success, the value to the organization in economic terms might be $1 million in new profit per year. Let's just use that hypothetically. You're going to create additional profit of $1 million per year, recurring. Then the next question is, well, what would you pay for this? What would this be worth to you? How much would you pay for such value? And so there's all kinds of nuance around these 4 steps, but this is essentially the 4-step framework for navigating the value conversation. It's simple, but it's not easy. It's not easy for a few different reasons. Number one, this is a issue of tacit knowledge. You cannot learn this from me telling it to you. You cannot learn it from reading it in the book. You have to practice it. You have to practice it and fail forward. Now, the goal of switching to value-based pricing is not to charge more to your clients. The goal is to create an organization The goal is to create an organization that is laser focused on innovating for the client and creating extraordinary value for the client. That is the goal of value-based pricing, to get the people in your organization and your entire organization focused not on the pursuit of efficiencies, but on creating value for the client. And when that happens, when you see it happen in your own behavior, there will be this mindset shift where you unlock the highest level of financial reward possible in a marketing services firm. There are 3 levels of financial success. The first one is the efficient firm, where you're capturing and billing as many of the available hours as possible. But we talked about the cost of that, right? The second level of financial success is what we would consider to be the progressive firm, that uses things like options and anchors to charge more for their clients. And the third level of success, the highest level of success, are the value conversation masters. Those people who, who master the value conversation. They get to the highest level of success because imagine what it feels like to be on the end of a conversation where somebody is using this framework. I believe that mastering the value conversation is the most valuable skill in all of business. Now, think of the people you know in your personal life where you meet them, you see them from time to time, and at the end of the meeting or the exchange, you think, oh, wow, what a great person. They're so wonderful. And you realize, oh my God, once again, we ended up talking about nothing but me. I didn't even ask her how she was doing. And the reason she's made you feel so wonderful is in the brief conversation you've had, she was intently focused on you. And you felt like you were paid attention to and you were valued. Now translate that into business. Now imagine that person bringing that level of focus on the client to the client interactions. The key to mastering the value conversation is, by the time you're done, you are 3/4 of the way through the sale and you have not even thought about your solutions. That is the key. That is the shift that has to happen, because all of us, we go into these sales, we're already thinking about what we're going to sell to our clients, right? If you really are pricing the client, not the job, if you really are following this framework, you're not spending any time thinking about what it is that you'll sell to the client. You should be able to leave the value conversation. You've established what the client wants. You've established the metrics of success. You've established the value of hitting these metrics. You've set a price range or gotten some sort of what the client might pay. Then you go back to the studio and then you think about what you would do. So this really is the next level of business success, is to really just simply master a conversation. We have a challenge in the creative professions, and I talk about it in my first book, The Win Without Pitching Manifesto. This is the second proclamation in that book. We will replace presentations with conversations. The dirty little secret in the creative professions is we're not very good at conversations because we are so focused on the presentation. But you can be present to people, I'm fond of saying, or you can present to them. You can't be both. You can't be present and also present to them. So it's the dirty little secret, is we kind of build our business around the presentation. In fact, we love presenting so much, we're willing to do it for free in the pitch. So the whole next level of success is this ability to master the value conversation. When you do that, you will transform yourself and you will transform your firm. Some of you will get there. Most of you, I would be happy if you got to, say, the progressive pricing level. So here are the 6 things I talked about. All value is subjective. Efficiencies come at the cost of extraordinary profit. Those are the 2 principles. Price the client, not the job, was the first rule. Offer options is the second rule. Anchor high is the third rule. And master the value conversation was the 4th rule that we talked about. It's actually the 5th rule. There's a 5th and a 6th that I didn't talk about. I'm going to turn it back to David in a second, and we'll take some questions. But the book is Pricing Creativity. It's available only at pricingcreativity.com. It's the first pricing book in the world, priced based on the principles in the book. It's available in different options, different prices. It's expensive as far as books go, but it's fully guaranteed. Training information at Win Without Pitching. My podcast is 2 Bobs, and I'm Blair Enns on most social media. Thanks. Sorry, I went a bit long, David, but I think we have 5 or 6 minutes for questions if you want to hit me with some.
Absolutely. Thanks so much for that, Blair. That was absolutely fantastic. I had no idea that the Nike Swish was only $35 back in the day. That's amazing. And I really enjoyed your explanation and your example of using an anchor when your friend used the 3 million as the anchor and got
30 million.
30 million, sorry. And they came down to 300,000, was that right?
Yeah, and the budget was 30,000.
That's insane. That's amazing. But yeah, there's a huge amount of actionable and insightful content there, and I'm sure our listeners will agree that there's a lot that they can take away from this short snippet. So thank you so much for that. So yeah, we have a couple of questions, and if anybody has any burning questions they'd like to ask Blair, feel free to tweet us at #AgencyExpertSeries, and we'll do our best to get to those before we finish. So Blair, I would like to talk to you a little bit about the power in the relationship between buyers and sellers. And more often than not, it's the client that has the power. And how do you think that the seller could really take that power back?
Yeah, so that's the first chapter of my first book, The Win Without Pitching Manifesto, talked about that. And I can actually distill this idea of win. So my main business is Win Without Pitching. It's a sales training organization for creative professionals. And I can distill this idea of winning without pitching down into, and it relates to pricing as well, but I can distill it down into 2 steps. And first is to gain power in the buy-sell relationship. And the second is to leverage it. So some people are probably thinking of these, the things that I'm talking about today, and they're imagine trying them on, and they're thinking, I just don't think my client's going to go for this. And usually when that's the first thought, the first thing I'll say is you reinvent your firm one new client at a time. So it's easier to apply some of these principles with new clients, but I would suggest you go ahead and try them with current clients. But if you're thinking, I don't think my clients would go for this, it's because you lack power in the buy-sell relationship. And the source of that lack of power is the availability of substitutes in the eyes of the client. So the client thinks that, well, if you don't lower your price, that's okay, because there are 4 or 5 or 45 or maybe 4,500 other firms just like yours who will do this for a lower price. So that's part of, if somebody's listening thinking, I don't think my client's going to go for this, I'm suggesting that you're probably used to A, pricing on inputs, and B, feeling like you have no power in the buy-sell relationship, and that's the source of the client's power, the fact that you're not different enough. So how do you get that back? It's through positioning. And I know everybody on this call knows the value of thought leadership. If you think back to that that framework of the arc of the sale with 4 conversations, the first conversation is what we call the probative conversation. And that's where you prove your expertise to the client, and you move in his mind from a vendor to the expert practitioner. And so the key to the probative conversation is, ideally it happens without you even present. It happens from the client interacting with your thought leadership, reading something you wrote, listening to your podcast, watching your YouTube channel, whatever it is, listening to your speech and thinking, oh, wow, this person really knows what they're talking about. That's when the shift happens. We refer to that shift as the flip, the mental flip. So when you go from vendor to expert practitioner, now you have power in the sale. So it begins with you being positioned properly, and then you leverage that through the content that you create in the promotion of your firm. And when you do those 2 things well, then in the beginning of the sale, most of the sales, new business opportunities that you encounter will see you positioned as the expert. Sorry, that was a long answer to a very good short question.
I really like the vendor to expert practitioner line. I think that really kind of sums it up. So another thing that I'd like to touch on is about new businesses or young businesses, in particular in agencies. I think this is a problem they come up against, is when they, put together a new service that they're offering, is the issue of trying to price that new product or service. And how would you advise agencies or young companies to decide how much they should price a product or a new service?
Yeah, and so again, it goes back to that that issue, rule number one of price the client, not the job. So I think it's a mistake to sit there and think, okay, we've got this new offering. I think we should charge X for it, or even a range of X to Y. You should think, okay, here's a new offering. And the reason, if you really are pricing the client, not the job, you're following the first rule of pricing creativity, then you are going to invent all kinds of new offerings. You are going to stress the boundaries of your very business model, and you will find yourself doing for some clients things that you've never done before. Then you'll go to a next new client, you'll do something else you've never done before. So I would suggest, and that way your organization becomes more entrepreneurial, and you bring back these opportunities. And it's risky. It's risky to do these things you've never done before. But Peter Drucker said it best: in business, all profit comes from risk. And generally speaking, the higher your prices, the more risk you are taking. The lower your prices, the more risk you're passing on to the client. So it opens you up to these more entrepreneurial engagements where everything is different, where you're taking more risk, and in exchange for that risk, you're generating the opportunity to make significantly more money. So I think we need to quit thinking about launching products to our clients.
Yeah.
And we need to think more like consultants and just figure out what's right for this client.
Yeah. Great. Thank you. We're just at the hour, so I'm going to ask you one last quick question. And it's a bit of a quick fire question. So what do you think are the 3 biggest mistakes creative professionals make when they are thinking about pricing?
Yeah. And the first one is, I think, Ron Baker, in that quote I shared with you, the 2 big ones are just generally underpricing. But the biggest one is pricing the product or the service and not the client. So, and then, not offering options. I don't think I would add to that list anything that I didn't talk about today. I would say not pricing, and especially among this audience, the biggest mistake is pricing the service, not the client. The second biggest mistake is not offering options. And the third biggest mistake is not trying to master the value conversation. Basically having your focus be on you and the firm and what you might sell to the client, rather than on having your focus be on the value that you might create for the client.
Right. Great. Thank you. Well, that's actually all we have time for, everybody. Blair, thank you so much for taking the time to bring us through that brilliant presentation. And thanks to everybody who's tuned in. We'll be back hosting another episode of this series on the 13th of June with Carl Sakis of Sakis & Company. And he's going to be speaking about how you can become a better manager in 30 days and helping you learn concrete tips that will make leading marketing and creative teams easier. Blair, again, thanks so much. It was a real pleasure going through that with you with some really, really interesting examples. And I know our audience can take some real insightful actions away from today. So thanks again.
Thank you, David. My pleasure.
And thanks to everybody who's been listening. And we'll be back, as I say, on the 13th of June. All the best. Take care.